After developing a portfolio of iron ore, manganese and uranium assets, in mid-2009 you surprised us with the gold prospect at Migori in Kenya. Could you describe how that project came about?
Well, we knew of this asset, and the company that held it was a company that had run out of money and was, because of a failed transaction, was suspended from trading on the Toronto Stock Exchange, and there had been nothing going on there for quite some time. And so we did a deal with them, and we thought it was a good deal. We initially have 15% of the asset with a farm-in, which will take us to 60%, depending on us proceeding with the exploration and doing some sort of bankable feasibility. Bankable feasibility is fairly elastic. It depends what we're doing the bankable feasibility on. It could be something large, it could be something small, it could be something at surface. But we feel quite comfortable that there will be something there that will be bankable, because really when the gold price was lower, there have been some studies done based on the previous exploration and the resource established, which have worked out that at lower prices the thing was economic, or possibly economic, for an open pittable on some parts of the resource. We're now talking about a much higher gold price, and so that's a start. Because the focus of exploration over the last 20 years has been on open pittable surface mineralization potential, and so that's what's been proved up, and that's really what the 1.1 million ounces consists of, and that's therefore a good starting point. So we got in there, but in addition to making that investment, we have bought into the company that was suspended itself, and are now the largest shareholder there with a purchase with shares and with agreements to buy shares totaling 35%. And you know, we may need to raise a little bit of money in that company, which could involve a little bit of dilution. But essentially at the moment that means that we have an attributable interest already of 45% in the project. And if we proceed and we farm in, of course we gain on one hand, lose on the other, but our shareholding net will go up. But an additional point about our agreement is that if we manage to produce any gold from the project, or any from the mineralization there, we can use those revenues, first of all, to defray our entry cost, then to defray our operating costs, and then to defray our bankable feasibility costs. So we have every interest in trying to get something produced from the surface deposits or the tailings as quickly as possible.
You recently announced you're looking to revise your 43101 resource. Could you briefly explain the difference between 43101 and a JORC resource from a standards perspective?
Well, the JORC is the Joint Ore Reserves Committee of Australia, and National Instrument 43101 is the national instrument of the exchanges in Canada, which reflects and amplifies slightly the Canadian geologists' protocols that are similar to JORC. The 43101 is not necessarily more prescriptive than JORC. It's restricted in a way in that although there's some cross-recognition of professional qualifications in England and Australia, the Canadians are a bit naughty and nationalist, and unless you're a registered Canadian geologist, you can't sign off on a 43101. Otherwise, they're essentially the same.
I think it will be useful for viewers to have a brief explanation as to the difference between inferred, indicated and measured resources.
There's obviously a confidence level, and you have to have closer drilling and more work done in order to get to an indicated or a measured resource. Interestingly, and here I will digress for a little and refer specifically to our license, which is about 63 kilometres long along the Greenstone. Only about 10 kilometres of it has been explored, which, curious enough, is the 10 kilometres nearest the camp. The area that has been explored is this area here, just near the old McAlder mine, the VMS mine, which is part of our license, which produced copper, zinc, as well as gold. And these licenses are what we call MK, Nyanza, KKM, and Gori Maria. And the KKM was what Orvista drilled with RC drilling in the mid-1990s. That's a company from Australia. And of the 1.1 million ounces, over 600,000 ounces is just the KKM surface mineralization in 2 or 3 pockets. And that surface mineralization of over 600,000 ounces, they very nearly got it measured resource rather than indicated. The reason they didn't in the end get measured resource is because their downhole survey instrument couldn't be used on some of the later holes, and I think it may even have got lost down one of them because they got some caving in of the hole, and the instrument was lost down the hole, and they didn't get a new one in time. But they were so close to having a measured resource that we're talking to geologists and the people who do the resource calculations to see what extra work needs to be done to bring that from indicated to measured. Because, for example, if you take one of the independent research houses that's looked at this company, Edison, who published research on it, they value indicated at something like $38 an ounce. This is from memory. But they value measured at about $300 an ounce. So in terms of the valuation that we think analysts would put on what we hold here, if we can bring more than half our resource from the indicated to the measured category, which was nearly done in the 1990s, it was only just by a tiny bit that it was missed. We just find out what we need to do to bring it up, and it's not going to be much. So that's a good starting point. So most of it's indicated, what we have. A bit is inferred. Some of it we think can be measured. And then in the tailings itself, we've intensively drilled that over the last couple of months. So we think that in the tailings, there's going to be cobalt, copper, zinc, and gold, and silver. And we're going to send that all off for measurement in Australia and to look at the metallurgical and physical properties of it, because if we can make it work, nothing is easier than to treat those tailings, and it's all a question of economics. But treating the tailings and getting the mineralization out, theoretically it should be easy because you don't have to mine anything, it's sitting there. So that will be our number one opportunity that we have to look at. It's been looked at in the past, it was believed there was potential, but because the details of that work are not in the records or are lost or in companies that didn't keep records, we have to do it again, but we've already done the work for that.